Welcome to Zen and the Art of Real Estate Investing. What if you could learn from experienced real estate investors, find out what got them to where they are now, get insight into their daily habits, and take these insights to inspire your own growth? Each week, Jonathan Green shares an in-depth look at the mindful approach to real estate investing. Jonathan is a lifelong real estate investor, advisor, and coach, as well as the founder and team leader of Streamlined Properties. Whether you're looking to start from scratch, get to the next level, or just for a straightforward and honest approach to real estate investing, Jonathan seeks to provide a free mentorship program you can take with you anywhere. Now, here's Jonathan.
Thanks for showing up for another episode of Zen and the Art of Real Estate Investing. Today, my guest is Mark Khuri, the co-founder of SMK Capital Management. They invest in private real estate, highly vetted, highly diversified. So that's where they want their clients to be able to diversify their capital across asset classes, regions, and operating partners. And that's what we talk about now. Let's go. This is episode 251 of Zen and the Art of Real Estate Investing with my guest, Mark Khuri. Mark is the co-founder of SMK Capital Management. He has over 20 years of real estate investing experience, started in 2005. I know, we've been in this a while. I've been in it longer. He started in California and Florida doing residential real estate investments. Now at SMK, they've invested in well over 50 commercial real estate opportunities across numerous asset classes, which we're going to talk about, but they involve mobile home parks, self-storage facilities, multifamily, retail shopping centers, oil wells, student housing, vacant land, short-term debt, and niche sectors. Mark, welcome to the show.
Thanks for having me, Jonathan.
Yeah, it's good to get you on. And you guys are really a diversified opportunist of an agency because you're doing syndications, but you're looking at a lot of different asset classes. Tell the listeners why and why it makes sense for what you do at SMK.
Yeah, so it's been a big foundation of our investment thesis since day one, Jonathan. Diversifying. Where did it come from? I mean, for us, I think probably a lot of the thought process was around reducing risk.
Yeah.
Spreading capital, right? Multiple asset classes, operating partners, geographies, strategies. Because we started our firm, really right around the recession of 2008 and 9. And the world was falling apart and everyone was trying to reduce risk while still earning an attractive return. And so that's still been with us since day one as far as diversification and how we continue to think today.
Yeah, and I guess starting at that time, you look back at what had happened and what was still happening, thinking like, hey, well, if we're going to build this into the future, what are people scared of? Losing all their money, right?
Of course.
Yeah. Yeah. I mean, why did you decide to start then? I mean, it seems like a time when definitely there's opportunities out there, but you just gone through something where so many people lost it in 2008.
Sure. Yeah. So, I started investing in real estate in 2005. So kind of before or during the upswing, depending on location, of course. And then at the time, Jonathan, I was working full-time W-2. I was a financial analyst for Raytheon Company for a number of years. And real estate investing was, on the side. My father is a mentor of mine. He's been an investor since the 1970s. And so I got my start, in my mid-20s, let's call it, right?
Yeah.
And of course, 2008 and 9 hit, but what we had been doing while working in the W-2 is my family and I had been partnering together, pooling our own capital, buying properties. Most everything we were buying was heavier value add, distressed properties, foreclosures, courthouse steps, REOs, short sales, boarded up houses, duplexes, fourplexes, and just, rolling up your sleeves and getting into it and creating the value manually. And we built a small portfolio of properties in a few states through that time period using family capital. And then by, 2009, I'd left the corporate world and really wanted to go full time into the real estate investment business. So that's when my father and I partnered and formed our firm, SMK Capital Management, to really just kind of expand on what we had been doing as a family.
Yeah. Oh, that's so awesome, because I grew up with a dad who was an investor, following him around, a 2-year-old, going to foreclosures and courthouse steps auctions, buying weird stuff. But yeah, I think back now, like he passed away like 20 years ago, and I'm like, oh man, that would be so cool if I could, do this with my dad. But part of the podcast is really an homage to all that he taught me. So it's so cool that you guys formed that together and then are able to continue still working, which probably started with just, hey, let's just pool our money, get something, see what we can do with it, right?
Yeah, absolutely. I mean, he had experience, of course, for decades prior to that, but I was relatively new at the time. And so having a great mentor and I would say someone guiding us through all of the uncertainty was very helpful.
When you were growing up, though, how much access or mind did you give to real estate? Because you obviously went into a different field, but it must have been around.
It was around, yeah. I mean, in my early days, I've got two brothers as well. And one of my first memories, two memories, but my father owned, I think it was a 60-unit property in upstate New York, where we're originally from.
Yeah.
And for some reason, his property manager, Jonathan, would call every night or so around 6:30 when we're sitting down having dinner. Yeah. And she's a very heavy smoker, just to be transparent.
Yeah, yeah.
And she would, her name was Fran, and like we still joke around in my family today, but she would call and I'd pick up the phone. I'm probably like 10 years old.
Yeah.
Right, and she'd just say, "Hey, honey, is your father home?" And you just knew right away. Like, oh,
I mean, Fran really sounds like the 1979 property manager, chain smoking in her office. I'm getting the vibe because I knew those 100%. People. Yeah.
Yep. So, we were around it for that. And then, my brothers and I would count all the quarters and put them in the little bank sleeves from the laundry machines and be able to deposit that. So in that context, it was around us. So then in college, when I was studying finance, one of my favorite classes was in real estate investment. And so that opened up my eyes a bit more as well. And so that's some of the earlier memories.
When you look back, though, did you think when you were younger, even as you got towards college, did you think of your dad as a real estate investor? Because the way that my dad was an attorney, but all he did was real estate, and he could care less about his law practice. He just did it like for free. But I never thought of him as a real estate investor because there wasn't all this like social media content out there that was, grandstanding everybody as an investor. It was just what smart people did on the side to make more money.
Yeah, no, I didn't think of him as a real estate investor.
Yeah.
Very similar. My father is a retired orthopedic surgeon. So he put casts on me and my brothers many, many times at home and fixed our broken bones. So that was always what came to mind first when you think of my father.
Yeah, but then I bet as you got older and then you saw what he was doing, you guys started doing it together, you're like, wow, okay. But isn't it interesting that now like real estate investor has become such like a first note for so many people? But for the people who've been in it the longest, like as I was saying, it's just something that you did because it was smart and it was an alternative side hustle before the term side hustle even existed.
100%. I mean, I remember, we probably all know this quote, but I probably heard this in my early 20s as well, which helped me, kind of open my eyes outside of the corporate world. But more millionaires are made through real estate investing than any other asset class, right? So that old quote that I heard at a younger age just stuck with me, and you still think about it today.
Yeah. And one thing about people like us who grew up with dads who are investors, and people can get if they read The Millionaire Next Door, the traditional investor back in the 70s and 80s, you would have no idea who they are. They're just living their life, working a completely another business, but they could have 100 units, buying foreclosures, and nobody would know. It's like now everybody wants to put that as the top, at the top of their bio. You've obviously created a company to make it realistic, but I find like it's a weird time now where so many people are kind of want to be an investor. But before this, everyone just did it and didn't need the tagline or the credibility of having that there.
Yeah, I would agree, Jonathan. And I would just say to those listening that want to be the investor, real estate investor, it's not as sexy and glamorous as some might make it out to be. We're really in the people-solving business and problem-solving business. And I would say, make sure you realize it's a long-term wealth growth strategy.
Yeah, I think that's a great statement. And I've always, I learned that, but I think that it's more short-term thinking, not necessarily a people problem because of it, but it's because that's what the content says, you can get rich quick. Right. But like, as you were saying, most people don't realize, like, you're signing up for your second 9 to 5 job. It's not a side hustle. It's going to be a job that's going to ruin your other job, if you get a 50-unit apartment building as just a solopreneur.
Absolutely. And then if you want to start renovating the units and grow revenue and manage all the contractors and the property manager, be ready. It's going to take a lot of your time.
Yeah. I mean, that's part of the reason I like having this podcast. We can tell people these things and hopefully they can learn from things that we've seen so they don't go out and do it too much. But, everybody has designs on it. Now, as somebody who runs this capital management company, when somebody's coming to you, what are you looking to find out from them to see if they're a good fit for what you guys do?
Yeah, absolutely. I mean, it has to be a win-win, right? So some of the things we look for is what are their goals, first off? Yeah. What are their pain points, second off? And are we potentially a solution that can help them solve their problems and achieve their goals? And so it's a conversation, of course, Jonathan. It's understanding their experience level as well and what we do and how we do it. How involved do they want to be in due diligence and underwriting versus being more passive, and really just trying to determine, where's that sweet spot of potential context to work together.
Yeah, the win-win context is really important because I think a lot of people don't understand it. And certainly when you start a new business, you can't be as choosy. You try to be, but also, you got to get these first deals going. But as you get further along, it becomes more and more important because you're trying to keep a steady stream of people who are invested in your process, which can be different from other people who are running similar deals, right?
Yeah, absolutely. I mean, first and foremost, if it's let's say a new relationship, no referral, no previous contact, right. And it's all about trust, right, Jonathan? So how do you establish trust? It takes time, it takes clear, consistent communication, a lot of back and forth, questions, answers. I mean, you understand, but the first step is establishing some sense of trust.
Yeah. And you guys are, based on what you said before and from what I've read, like risk mitigation is really important to you. And that provides a comfort level for those investors who have disposable income, but don't have the time, but they never pull the trigger because they never feel comfortable enough, right? How do you get across to them why what you do is mitigating the risk versus maybe a one-off syndication of just one property?
Sure. Yeah. I mean, the general concept is relatively straightforward. Most people grasp it pretty quickly, Jonathan, right? It goes back to the old adage of not putting your eggs all in one basket, right? So there's pros and cons to investing in one asset on 123 Main Street, of course. But you also, what comes with it is higher risk, right? And so investing in, a diversified fund, which is something we constantly try and build and evolve and create for our investor network, allows you to spread your capital across multiple properties, geographies, operating partners, different durations and strategies, as I mentioned earlier. And so when you share that with folks, they understand that like, oh, okay, this is a little bit lower risk than going and investing in, a passive LP investment in a 250 unit property in Dallas, Texas, for example.
Yeah, I'm in one. You just called one. But see, but I'm learning those lessons as well because for me, I was trying to peel back the layers of my control freak nature. So I still like the one property syndication because I feel like I can't have any control, but I know the asset, so I've studied the asset, but now I have more fund managers, people who do more funds. And it is interesting to me because I like index funds and stock because it's just set it and forget it for me. And I know, one goes belly up, another one goes up. That's part of this diversification. And you made a really great point. And what I found from other people who do funds, it's so interesting that diversification, a lot of people just think, oh, asset class, geography is super important. Operators super important. The timeline is really important. And I don't think that your regular new investor who's not savvy on passive investing understands how diversified you can actually get inside a fund. So talk about that a little and those other demographics and things that you're working in.
Yeah, absolutely. Yeah, the details and the nuance and the niche asset classes, all put them together in a fund. It's a lot of work. It's much harder to create than, of course, a single asset investment. But there's benefits there for everybody involved. But some of the nuance, and makes it some of the things that make it a little bit different. We like to look at income and growth, and we have in some of our recent funds, and the current one that we're building as we speak, soon to launch, is fixed income as a portion of the portfolio allocation. And so that just helps increase yield, day one to investors in conjunction with, kind of a little bit more of a blended income approach with growth. And so maybe we'll take that 250 unit apartment community that we described, assuming it meets our investment criteria, and give it a slice of an allocation in our fund. And then we'll also potentially put in a private debt fund that's already producing, 9, 10, 11% in yield.
Right.
And then also look at some more value add strategy and potentially some growth strategy. And so what that does for an investor, if you think about their capital being put to work, usually in year one, they're able to achieve cash flow. Usually we're trying to target, 3 to 5% at least in the first year net to investors. And then we look to see that growing over the next few years. And then we like to try and return capital, a portion of it, right? So from the debt funds, they're usually shorter investment durations. We can redeem our interests and return principal back to investors in year, maybe 3 or so.
Yeah.
And so that anytime you're in an investment and you're getting your principal back, you're reducing risk right off the board. You could take that money and put it in something else, the next day if you choose. Yeah. And that allows you to compound your return over time. If you continue to do that, you'll obviously generate, very attractive returns. And so that's part of the life cycle. By year 5 or so, we're typically returning a good chunk of capital from property sales, refinances, and redemptions. And so we like to see that there's still ownership in assets continuing to produce yield, even though we've returned, a portion or maybe even all of the capital, the principal to investors.
Yeah, and part of the creation of funds is kind of this Tetris effect where you're trying to match properties that can balance each other out to create this fully safe entity. When you're doing that, do you have a set number of properties that you want to put in, 10 deals, 12 deals, or does it matter, depending on the size of each deal?
Yeah, we do. We look at more of not just properties, Jonathan, because a lot of times we'll invest into portfolios. Might own 15 or 20 properties, and that might be one investment in the fund.
Yeah.
But we'll look at total deal allocation, like how many deals can we source and get comfortable with to invest in the fund. A target range is called 7 to 12%, 7 to 12. And so that way you have I don't know if you're familiar with Ray Dalio's investment strategy, the Holy Grail of investing. You can Google it. But he talks about this in great length where you're talking about risk and reward, right? And so your reward should stay relatively constant. That's your return. But you can drastically reduce risk by allocating capital to roughly, 7 to 12 different lowly or uncorrelated deals.
Yeah. And do you think that it's been easier? For good fund managers to have stayed steady over the last 3 years, where a lot of single entity or single asset class syndications have definitely suffered from either floating rate debt. If you have 12 properties and one was on a weird debt, it could go, you could fix it because you have other properties to balance it out. But a lot of the problems that we've seen in the syndication world have been on single properties with debt that didn't match up to the timeline that they could complete.
Absolutely. You hit it on the head. That's a big part of the reason why we continue to do funds is they tend to have a higher likelihood of continuing to perform during various market cycles. And so that's what we've seen and experienced over numerous different hurdles in the economy and market in the last, 15 years.
Yeah, and a lot of people look to, I got into multifamily syndications as an LP because I don't want to buy my own multifamilies because I don't enjoy being a landlord. But I thought it was cool, hey, I can be invested, I can read the monthly. But when you're in a fund, you can have access to so many asset classes. And then you can tell people, hey, look, I'm invested in 7 different asset classes in this one fund. And I think that gives you a talking point that maybe people are really looking for instead of the people like we were talking about who are maybe overreaching and trying to do more on their own and then realizing I don't have the time to do all this. Who can match up on their own, all of these different, let me do student housing and I'll get a, one storage unit and then I'll get some retail and then I'll do some, elder care. You just sign up for your family, sending you out the door because you're never going to have time to do it all.
Yeah, it's a lot of work. Analysis, underwriting, deal vetting, selecting the deals. It's much more than just a full-time job, right? So obviously there's folks out there, professional investors that do this all day long and they have the time, the resources, the experience, the knowledge, the connections, and they can do it. But most folks can't. And so that's a bit of the value that we like to add.
Yeah, what's one smaller asset class that you try to work into a lot of your funds that maybe doesn't get the publicity or accolades that it deserves?
Gosh, okay. Yeah, I mean, there's a couple that come to mind. I'm just, mobile home parks is obviously a big one. I think most people have heard about them at this juncture. 10 years ago, Jonathan, different story. The cat's out of the bag. And
so, it definitely is.
We still love them. We continue to, it's one of our favorite asset classes, and we could talk about it for hours, but we continue to invest in them. We just find them as a risk-adjusted return to be near the top of our list.
Yeah.
Another one is triple net industrial sale leaseback, which not everybody's heard of, but in short, it's industrial property that is tenanted by the owner of the property, usually manufacturing type businesses or distribution businesses. And the owner of the real estate and the company want to sell the property, the real estate, and a lot of times inject that capital back into growing the business.
Yeah.
And so very interesting kind of play where, they're triple net. So the tenant is essentially paying for all the expenses. Doesn't matter, taxes, insurance, utilities, repairs, you name it. And so that provides a bit of inflation resistance on the expense line items, which have skyrocketed in the last several years. And then you usually have long-term leases on these, Jonathan, right? 20 years is common. 2-3% annual rent escalations built into the lease from day one. And so we like those transactions. You have 100% occupancy when you buy the property because the seller becomes your tenant. And so some nuances there that not a lot of people think about, and some benefits of those asset classes.
Yeah, really. I mean, triple net is as passive as it gets. Really, the only problem is if it's a single tenant, and they move out. That's when you have to figure it out, right? But it's a different bet when you're betting on the person who just owned the building and leasing it back to them, and they have already a 20-year history of doing well, and they're just continuing to do it. That makes that's I guess even a less risky proposition than doing it with like an Arby's or something.
Yeah, no, 100%. I mean, same concept with like strip retail. We try and focus on diversified tenant base, and we're not looking for a single tenant. And so in the triple net space, we're usually investing in portfolios, Jonathan, that have a dozen or more properties and tenants in them.
Yeah, but this is like two levels of risk mitigation when you guys take it and then invest in a portfolio of properties, because then the portfolio helps mitigate itself. And then you put that inside another deal with all separate asset classes. I mean, you're really taking a high risk, like we were saying, from, just 250 units in Dallas, like we were saying. You're boiling that down to just much less risk, even though I think from my point of view, I'm assessing the risk up front. I like them both. But for the people who don't have the time, put it into something where you're really balanced against it all the way. I really like that. And those portfolios give you a really extra layer in that. Am I right on that?
Absolutely. I mean, you nailed it on the head, Jonathan, right? We like investing in portfolios, especially when there's a potential aggregation play, where you see this a lot in mobile homes and self-storage, and also in triple net industrial, where the acquisition price of each individual property is, call it too small for the bigger guys.
Yeah.
And so, there's sponsors and operators out there that we work with that focus on aggregation, where they're going to build a portfolio of 10, 20, 30, 50 properties that are all, 1 to 10 million, give or take, in acquisition price, and then potentially have the ability to roll that up and sell the whole thing to a larger private equity or institutional firm.
Yeah, I mean, this goes to something that I always talk about, and it comes up on every show. This is where relationships mean everything, because it's not like you can just go out, and look on Redfin for a package of 12, multifamily that will fit in perfectly with the rest of your portfolio. It is a lot of what you guys do in this business now, built on past relationships, building new relationships, because it's, everyone thinks traditional home buying, like how you started, you go on Redfin, look at a property, go get it. This is not how it works in large scale commercial asset classes like we're talking about.
Yeah, exactly. I mean, we're really focusing in the private real estate space.
Yeah,
right?
exactly.
So you have to have those relationships. You need to know who to trust and who not to trust, who to avoid. I mean, one thing we share with prospective investors is over the years, we've analyzed and vetted, over 150 different real estate sponsors and operators in different sectors across the country and different asset classes and industries. And we've narrowed that down, and it's an evolving, constant process, Jonathan, right? It's not just up front, it's in the middle and on the back end of a deal with them as well. And so those relationships are key to success, deal flow, and being able to avoid risks and get access to deals that you otherwise wouldn't have access to.
Yeah, I mean, that's how it shows up. And I just think it's something that for someone who wants to get involved, you just don't you can't do all this work. What are you going to do? Build 20 years of a reputation in the multifamily space, in 6 months? It's just not going to work. So whatever people think they're going to have access to, it would take so long to get to the relationships that you guys have already built over the years. So your access is much limited when you're brand new. That's why you need to start to learn about these things in advance. Hopefully they can take some of these tips and go. Hey, it's Jonathan. I hope you're enjoying this episode with Mark. Before we get back to it, I just wanted to remind you that we moved our mailing list content to Substack. So if you go to Trust Green, and Green has an E at the end, you should know that by now, .substack.com. It's going to be free all the way through to the end of the year, and then there'll be plenty of free content after that. But our mailing list is now going to Substack and turning into blog posts, and we'll be putting a lot of the podcast and event information on that Substack. It's free to sign up. It's free to follow along. When we get to 2026, we will be doing enhanced content. But for now, check it out. Let's get back to Mark. So we talked about a couple different asset classes, but geographically, how do you like to diversify? Are there any areas that you guys are staying out of, or is it still asset class specific?
Yeah, there's definitely some areas we typically stay out of. The Northeast is one, the West Coast and the coasts in general, although the Carolinas and parts of Florida are still attractive to us.
Yeah.
But we look for properties that we can invest into that are positively leveraged, producing positive cash flow day one. So if you acquire it and the next day something catastrophic happens in the economy or et cetera, the property should still be producing positive cash flow without having too much execution risk, where our sponsors and operating partners will have to come in and, add value in order to be able to create that cash flow. So we would consider that more of a growth investment.
Yeah.
But most of our bread and butter, Jonathan, is producing cash flow, first year of the investment. And those opportunities typically lie in the Midwest, the Southeast, Sunbelt region, of course, where you have call it a higher rent to price ratio than you would potentially the Northeast or the coasts.
How has all of the weather anomalies affected your kind of investment portfolio and ideas around it? Because you brought up North Carolina, and I was under contract on a small property in North Carolina, and then the Asheville floods happened. I was like, wait, I was only going here because it was weather resistant, and now my ideas on weather resistant really are not as smart as I thought they were.
Yeah, no, it's a great question. We think about it all the time because it's getting worse. Let's just be transparent.
Yeah, for
the
sure.
number of major storms happening each year is growing, and the size of them is much more catastrophic. And that, we think about it a few ways, but it goes back to the idea of diversification, where if you're invested in a highly diversified portfolio that has maybe a ownership interest in 70, 80 properties across the country, something happens to one or two, it's not likely to disrupt your performance very much at all. And so that's a big part of it for us. At the same time, if you're looking at an opportunity in Florida, be careful, right? Where is it? What is the likelihood of a storm having a great impact on it? And my folks live in Florida. Don't get me wrong, Jonathan. I love Florida.
Yeah, I lived there 14 years, but I don't invest there that much just because, it's uneasy. It's uneasy. I try to stick to the middle of the state if I can, but also I don't love Orlando. So I'm like, where do I go with this?
Yeah. I mean, there's we're cautious in those markets where there's an increase in potential for storm damage, but you can mitigate some of that risk by looking at, of course, is it in a flood zone?
Yeah.
What's the impact of previous storms, right? We'll pull up loss run history on the property for the last 5 years. And okay, well, this hurricane came and it hit Houston. And how did the property get affected? What kind of insurance claims were on it? And did it have a bunch of damage or not, right? And so you can start to see if that risk of storm damage outweighs the benefit of the deal itself. And a lot of times it does. And so you walk away. But there's also a lot of areas in the country that, if you look at the map as a whole, you might say, oh, I'm never going to invest there. But you find out that there's a lot lower risk of flooding and storm damage than you might think when you get into the nuance of it.
Yeah, especially if you're talking about newer builds. The newer builds were built differently. They have special credits. They're built against floods. They're backlogged better. So that's a better option than a 1950s that wasn't built to the same code. So there are a lot of things. But also it's interesting because a lot of the good deals after a weather anomaly come in the areas where there was flooding. So there's opportunity there. But for you guys, you're trying to just figure out, okay, is this going to happen again? Because we saw like in Tampa, it was like two in a row. And then you think, okay, well, how long until the next one? And it's just, like you said, it's different now. It's more often and in areas that we didn't expect.
Of course. Yeah. I mean, you got to look at the insurance policy, right? And are we insured for flood? Are we insured for loss of rents and for how long, right? You want to make sure that that revenue stream is still going to continue should there be, an event that takes a lot of units or homes or whatever it is offline. And I can share a quick story with you that just
please.
Brought up. But gosh, we were in Florida. This is probably what we bought this property, Jonathan, in 2007 or 8. The market in this submarket, the pricing in this submarket had just fallen off a cliff. And we said, gosh, how can we go wrong at this property? So it was a duplex side by side, built in 2005 and foreclosed on in 2006 and 7 when we bought it.
Yeah.
I think we bought it all cash at the courthouse steps. So pretty much brand new construction, stucco build, single story.
Yeah.
And we bought it, we renovated it, we had tenants placed, it was rolling great for about 2 years, producing great cash flow. And then one day I get a call from my property manager. He says, "Hey, Mark, we've had a fire." And I thought he was messing with me, Jonathan.
Yeah.
So I chuckled a bit, and I'm like, "Okay, so really, what'd you call for?" Right?
Yeah. Please,
Yeah. And sure enough, it was a fire. It was pretty bad. The tenants were home having dinner, and they had to climb out the kitchen window. And I just, this photo of the fire department and the hose, and the place was essentially uninhabitable. What had happened, though, again, you go back to storms. This wasn't a storm. This is just something that happens. If you invest long enough, these things will happen. But we had a Ford Excursion sitting in the left unit garage while the tenants were having dinner. And the thing just spontaneously combusted and went up in flames. Imagine that.
That's crazy. Yeah.
Yeah. So we were insured for loss of rents. We ended up hiring a insurance claim adjuster to act on our behalf. We signed our power of attorney to them, and they fought with our insurance company to get us substantially more for the property than we would have gotten had we fought on our own. And so there's ways to mitigate. Our investors ended up doing very well on that property. We ended up selling it just for as is to a flipper and walking away from it with the insurance premium. So it paid out.
Yeah, so when we talked about weather anomalies and what can happen, but this will again go to your diversified strategy. But now we're in a different, again, apolitically, we're looking at tariffs now and what they could, and each day it could change what you're doing in terms of building or the availability of wood or other materials for any type of build or just for construction or maintenance on these properties, even across all asset classes. So how are you guys going to look at that as this goes forward? We're recording on April 8th. It's going to come out in June, but it's definitely going to be an issue as we go forward. How do you try to figure out what's possible? I know it's staying diversified, but the tariffs could affect all asset classes, in some way.
Yeah, they could. I don't think anybody knows yet the extent, Jonathan, or how and when. So it's a little bit of a wait and see approach, but also try and, speak to our sponsors and operators in a very more specific subject matter as to, vintage, CapEx, deferred maintenance, where are these materials coming from? And we've already seen prices skyrocket in the last few years, right? And so some of that inflation expense increase that we've experienced is currently baked into current new deal numbers.
Yeah, I agree.
But be a little more conservative, right? Add more padding, put in a little bit more contingency, be safer about it. It's just timely as what you mentioned. One of the investments that we are targeting for our new fund, I was chatting with our operating partners just yesterday about it. And this is in the triple net industrial sale leaseback space. One of their targeted investments is into a manufacturing business in the US that's been around for 130 years. They went through the Great Depression. They've been through, anything and everything you and I probably can recall and a lot more. And so this business has been around for many, many years, but they produce, basketball courts is one of their products. So they produce the flooring for the NBA, for a lot of different universities across the country. They've got 6 properties in multiple states. And so you look at this, you say, okay, well, how do you analyze the risk of their supply chain and where they're sourcing materials? And, one of the things to take away from the conversation is they are using a specific type of wood that is sourced in America, in the US, in the forest right near their main headquarters.
Yeah.
And so they're not bringing in lumber from Canada, for example. So a lot less potential risk on their supply chain for, building this one specific type of product. And so that's just an example of some of the conversations we're having, regularly to try and see how to mitigate against the tariff risk.
Yeah, I think that's super helpful. Tracing the origin of the main sources that you're going to be bringing in is just important to know. And maybe you decide like, okay, well, even if the tariffs are here, if they're less in one area where you're importing from, you just, like you said, be more conservative and bake that in. But it's definitely going to be another thing that's added, to these pro forma sheets that we're looking at that needs to be considered, and good questions for LPs to be asking on something that is more of a heavy lift type of updo on a lot of units, right?
100%. I mean, development, I think, is probably likely to face the biggest brunt of it at this juncture. I mean, we'll see, but we don't invest in a lot of development, Jonathan. Most of the properties are stabilized and already built and leased and rented.
Yeah, just going back on something that you said before and how you guys do, if you're looking, it's important that you can, with the fund, you can add in a couple heavy value adds, but still the other properties are going to bring that instant income, which I think most investors like myself, I invested in all 3 that are delivering income right away because I just, if I'm going to park the money, I just want to get a little bit, to make sure I know what's going on. But that allows you to do, heavy value add somewhere else and balance it out, as you said before, with the debt fund. That's what's really interesting about funds to me. Have you found it that makes it a little bit easier for investors who are newer to understand? Or is it not flashy enough for some?
Well, there's a bit of both, right? We can't appease everybody. If you're trying to hit a giant return, we're probably not the right fit. We're focusing a lot on risk mitigation, as you said, but we're also, focusing on trying to generate a reward or return on investment that we think is pretty darn attractive comparatively to the risk that we're taking. And so that's how we look at everything, right? You can shoot for the moon all the time, Jonathan, and you'll hit a few home runs, and you'll also crash and burn a bunch as well. We try not to do that. A little bit more down the middle, but that's essentially how we look at it. It's all about risk and reward balance.
Yeah. Before you started SMK, did you invest yourself as a limited partner in any deals, or were you trying to figure it out from this end? Because I always wonder, how do you know what a limited partner expects if you haven't been one?
Yeah. So, again, when we started our firm, it was just family capital. We were the sponsor and operating partner on all of our deals. And when we went out to our investor network, this is in 2009 or 10 now, Jonathan, to raise capital outside of just our family money, we were not investing in anyone else's deals. We were not syndicating, right? We were doing our own deals for roughly, 6-7 years. That's what SMK offered. And so we built a portfolio of around 60 properties across multiple states with our investors, mostly single family, small multifamily, heavier value add, buy, renovate, rent, or buy, renovate, and sell. But at the same time, when I left my job in 2009, I opened up a self-directed IRA, and I needed to park some of those dollars into deals. And you can't invest in your own deals, of course, because it's a prohibited transaction. And so I started investing as an LP this is in about 2010 or 11 or so, Jonathan,
Yeah.
into, that's how we got into mobile home parks, right? We said, gosh, what has actually done okay or decently well over the last few years that we don't have exposure to, that I don't have exposure to? And mobile homes was the top of the list. And so for the period of about 5 years or so, while our firm was the sponsor and operating partner on the single-family, small multifamily deals, myself and various members of my family were investing as limited partners in, I think we did over 25 different LP investments
That's important.
during that time period, and other sponsors and asset classes. And that's what really got us looking and comparing and contrasting risk and reward profiles. And so that was a big part of a pivot in our firm, almost 7-8 years ago now, where we started doing more syndications and focusing more on diversification and different asset classes by partnering with other sponsors and operators that had already done well with our capital.
Yeah, don't you think I was thinking that's a good question for people who are talking to the GP directly, thinking of investing, to ask them about their LP experience. Because if you have a GP who's never been an LP, the deliverables might not be what you had hoped, because maybe they don't know, maybe they're balancing it off something else. But it's different when you're an LP and you receive the deliverable and you go through it and see if it matches up with what they told you in the beginning. So is that part of something you would suggest to people who are looking to come in as a limited partner, as a question to ask? And what other questions do you think are important that you want people to ask you when you're GPing?
Yeah, I think it's a great question, Jonathan. Obviously, understanding someone's background or experience, not just as a sponsor and operating partner, but also as an LP, and how'd you get to where you are? Why'd you pick this asset class? Yeah. Everyone's got a pretty interesting story if they're running a multi-million-dollar firm, for example. Usually, there's some pretty exciting things that they can share about how they got there along their way. But yeah, I would think it's a great place to start, and definitely something we focus on day in and day out with our sponsor and operating partners. Is just trying to understand how are they thinking and why, and what's their view on the best way forward in their specific niche, and how do they mitigate against risk.
Yeah, I have a question for you that the listeners may wonder, because I was thinking about it myself. I've definitely done fund shows, but when you're creating a fund, how do you balance getting the properties in and getting the money to buy all the properties? Because say you're going to build that 7 to 12 different deals into the fund. How do you do it with the money coming in from your investors, but also getting it for the properties when you don't have the full fund finished?
Yeah, it's a never-ending challenge, Jonathan.
Okay, it is what I thought then.
It's hard. So, there's different ways to do it, and I'll share how we do it. But I'll tell you what a lot of folks do in this space is they will create the fund, raise capital, and then call it as needed. So, meaning they'll ask you to write the check into the fund. Maybe they'll take 20, 30% up front.
Yeah, right.
And then over time, as they get deals, they'll call for the rest of it. We don't typically do that, Jonathan, for a few reasons. One, I've been turned off personally by some capital call funds because it could take 1, 2, 3 years to deploy the capital.
Yeah.
You have oftentimes a limited amount of time when they request the money to send the capital into a fund without being potentially penalized. And so those structures are oftentimes geared to more institutional investors that have portfolio capital sitting on the books that they can write the check.
It's not going away.
Right. For an individual investor, you might be comfortable with that. And that's fine. And don't get me wrong. It's definitely worth looking into capital call funds. But you really got to trust that the sponsor and operator is going to be able to source and identify deals that meet the investment criteria in a relatively attractive time period. And sometimes their time and money can be pressure. And so you could see a fund that's maybe a year and a half in, they still have only called 50%. And now the fund managers might feel pressure to go out and just find a deal, right? And you got to be careful of that. I'm not saying everybody does that. There's definitely some good stewards of capital out there.
Yeah.
But there's a bit of a hybrid approach that we like to take where we'll usually, when we open a fund, we'll have already identified the first few investments that we want to place capital into. And that way, the first tranche of investor capital that we raise will go to help fund those first few identified deals.
Yeah.
It reduces that drag time of risk. We don't necessarily need to create a capital call fund. But we also tell folks, like, listen, it can take a certain period of time for your preferred return to start to accrue. And so we try and be transparent. Like, we don't know exactly how long it's going to be.
Yeah.
But oftentimes we'll cap it. We'll say up to maybe 2 quarters. At that point, we have to put your money to work or potentially return it to you. And so that's how we tend to mitigate the ebb and flow of capital coming in versus, deal flow.
Yeah, that makes sense. That first I can see how it could work, that capital call type of fund. But also, if you're trying to place money in and get a tax advantage and they're taking too long, then you take the money that was kind of earmarked for it, invest in something else, and then they come back to you. Then you're in trouble because you've already kind of sent out the money because you couldn't wait any longer. But now you're in a potential penalty for not providing the funds from the call. So it could get dicey. These are all the more reasons for people to make sure that they're asking all the right questions. Because I think for someone who wasn't invested in syndications my whole life until last year, now I know a ton because of the podcast. But I think for someone just getting in, I don't think they have any idea on how complicated all the different scenarios are out there. So learning more about it, asking the questions up front, is really important to make sure that your risk tolerance meets up with what the fund or the syndication is doing, and if the timeline is going to match up.
Yeah, completely agree, Jonathan. Well said.
Yeah, it's been an interesting ride for syndications. Do you even have time to invest in one-off things by yourself? Or once you're in the GP phase, it's like, yeah, that duplex doesn't look as fun anymore. I got bigger things to do.
Yeah, we do. We do still do one-off deals, Jonathan. It needs to just have some type of unique situation, special circumstance that we think warrants taking a little less extra risk and not putting it in a fund. And so we do both. We definitely do. We like funds. We also like single asset deals.
Yeah.
There's just more risk. And so you have to be comfortable with that and feel that you can have the right team and the right business plan to work through those risks properly and still do very well.
Yeah, and most of us kind of like a little bit of risk. That's kind of the fun part of it, because that you get it, with risk comes return, as you were saying before. You want to make it so it's kind of balanced out and safe. But, for startup investors, they know you're going to hit 1 in 100. But boy, if you hit that one, you're good to go. Real estate's a little bit different. You need a little bit more boring in the tank to make it work. So yeah, it really makes a lot of sense. Where is the best place for people to get in touch with you guys? Is that at smkcap.com?
That's right. Yeah, that's our website. People can sign up, join our investor group, reach out to me directly. Emails on the website. It's also info@smkcap.com if people want to connect and ask questions.
Yeah, awesome. Well, yeah, it's been a pleasure talking to you. I love doing syndication shows because I always learn more every time. It's just not something I grew up with, you either probably, and you're making your way through it as well. But yeah, I appreciate you spending the time and I look forward to staying in touch.
Yeah, my pleasure, Jonathan. Thanks for the chat today.
Yeah, awesome. All right. That was Mark Khuri. He's the co-founder of SMK Capital Management. Again, you can find them at smkcap.com. I'm Jonathan Green. We'll see you next episode. Thanks for sticking around to the end so you can get a preview of who's coming up on episode 252 of Zen and the Art of Real Estate Investing. And it's Eric Burns, the founder of Flowers Capital, where they help entrepreneurs to live life bullish. They're going to guide entrepreneurs, that could be you, on their path to financial freedom through passive commercial real estate. We'll see you next episode with Eric.